in the journey from talk and interest to actual action in investing towards the SDGs. So I will start. Actually, I want to invite each of the panelists to briefly introduce themselves. You have the microphone, so why don't we start with you and just give a little bit of context. So thank you. Brief intro.
Me? Me? Ah, okay. So I'm Claus Stickler. I'm one of the two global co-leads of Allianz Investment Management. We are, so to speak, the asset owners in the Allianz family, covering all portfolios all around the globe of our insurance clients. And not only climate is a huge topic for us, but increasingly also SDGs, and therefore I'm very happy to be here today.
So my name is Elizabeth Boggs Davidsen. I am a director of SDG Impact, which is a new global flagship initiative at UNDP that's really working hard to remove some of the barriers and drive more integrity around SDG enabling investment at scale. So this initiative was launched on the margins of the UN General Assembly in 2018, and we've spent the last year building out a team and developing some new products that I hope are just that, removing some of those barriers and driving some integrity.
My name is Itske Lulof. I'm a director energy and climate at Triodos Investment Management. We have approximately 4.5 billion assets under management for a period of longer than 25 years. And we spend that funds entrusted to us 100%, so entirely in impact investment. And we've done that since the early days to generate environmental and social return alongside financial return. So for us, it's not so much about moving more money to SDG financing or investing, as we are already 100% impact investing. But generally for the whole market sector, of course, that's really important. We do so with several partnerships, and one of the partners, and that's maybe appropriate, is Alpha Mundi, who's also sponsoring this event. And we will launch a fund together. More about that next week.
Thank you. My name is Claude Barras. I'm the CEO of Obviam. Obviam is an impact asset manager based in Bern, in Switzerland, right between Geneva and Zurich. We do have quite a few impact investment mandates, the main one being managing the Swiss Development Finance Institution, which is called CIFEM. And we do also have mandates from some private clients. For us also, 100% of our investment are impact investment in emerging markets. So for us, the question is not whether we have to redirect part of our investment, but how we can mobilize more private clients to increase the mass under management of impact investment.
Great. So actually, Claude, I wanted to start with you. There's growing consensus around the SDGs as a framework for investment. But how can we make sure that this goes beyond intent and that we can really move investment beyond ESG towards SDG-aligned investment?
Yeah, very good question. I don't really have the silver bullet here, but I'm going to make a few comments. First, moving from ESG to SDG is clearly the objective that we have. But ESG will always remain the basis on which we can build the ESG portfolio. I mean, clearly, we're not going to get to do anything to achieve the objective number 14 if at the level of the companies they can pollute. If there is no gender, if there is discrimination in the company, then there would not be gender equality. So, I mean, it's not one or the others. SDGs are based on ESG investment strategy. The other thing that I think we need to say also, we have an incredible time now where a lot of people are aligned beyond the SDG, but at the same time, we have to be realistic. We're not going to go to billions to trillions. That's just too much. It's not realistic when we see what has been going on in the last 2 years. But we can go from billions to many, many more billions, and that's a more realistic objective that we can all achieve. Now, what can be done? I would say that there are three, at the general level, there are three axes on which we have to work. First, I mean, things needs to be improved in emerging markets, in many of them. A lot of progress have been made in the past, but still, I mean, we need the social infrastructure to be much better. If a country wants to attract more investment, you need a good quality education system, you need a health system. You need a road, you need electricity. That involves also obviously the good governance in the country in which the investment has to take place, but also we need an increase of official development assistance. We have to do more in terms of ODA in those countries. That's the first axis, to improve the condition in the countries of investment. The second axis would be to get better education, better information on what the opportunities are for the private sector. There is very often a misperception about the risk and the return from the private sector. The risks are overestimated and the return are underestimated. And there is a gap to close in terms of perception here. Still, there is a gap between what can be achieved, but it's not as large as one can think. That, I would say, is the second axis. And the third axis is to get much more clarity on what we mean by SDG. And how do we measure it? Because there is a lot of confusion. A lot of different people have a lot of different expectations what they mean by impact. And when it comes to, I mean, if we want to deliver on the SDG, we have to have clarity on what we mean by it. Otherwise, it's going to be very difficult to coalesce a group of investors under objectives which are not clear.
Yeah, and as many people in the room, I'm sure, would agree, we could have a conference for a whole week talking about impact measurement. I do want to come back to impact measurement later in the panel, but it's a big topic and obviously a very important one. You raised a very important point as well about the billions to trillions. And what we've seen through our work at OECD is that not only is it not realistic, but maybe that shouldn't even be the goal. Maybe it's about shifting the billions instead of just trying to have more money. Because if you're just throwing more money at the way we're doing things already, that's probably not going to get us there. So how can we innovate and make sure, first, money's going where it's needed, and secondly, there's real innovation in the solutions behind it?
Yeah, again, as I said, I fully agree. I mean, this billion to trillions doesn't help in the dialogue because it's not realistic. I think that there's one thing maybe what one should not understand is that investment activities are bottom up. They come from the field, and to have government or huge organizations setting targets that, there should be 200 billion of blended finance, it doesn't help because it's just going to distort the market and to have misallocation of money. It has to come from the field. The role of the public sector has to be clear. It's on framework condition. In some cases, it could be on blended finance. We can come later on what we should do in terms of blended finance, which can be extremely useful. But the investment activities are still the prerogative, and they have to be initiated by the private sector. And that's how it's going to work. It's not going to work top-down. We're not going to get any increase of meaningful investment top-down with a top-down approach.
Elizabeth, I know you all are doing some work related to this. Do you want to say something?
Well, that depends. I think I want to answer my impact measurement question more specifically.
But maybe about the mapping.
Right, so to jump to this, so when we set out to launch this initiative, we did some careful surveying, and we worked with an external firm to do this, and we spent about 4 to 6 months really talking to asset owners, asset managers, large companies, medium-sized companies, all different assets, trying to understand why is it that so little capital is flowing towards the achievement of these SDGs when you talk to enlightened financial and business leaders, they will tell you that the Sustainable Development Goals have become their guideposts for what they think is sustainable, responsible, inclusive development. So what we heard were there were two things we heard. One was that we would like to allocate our capital. We think these goals are important. We really don't know how to do that. And we really would like some guidance on how to do that. And these were signatories to the PRI and to some important principles and frameworks. And the second thing we heard, which gets to Karen's point, is that there is no market intelligence. There is very little information, particularly when you're talking about emerging markets. There's no MSCI, there's no Moody's, there's no Fitch. There's nothing really to help you understand where there are investment opportunities that really align and respond to the SDGs. And so these were the two sort of barriers that we understood across the board from all different investors that were really inhibiting more capital flowing towards the achievement of the goals. And so on the mapping side, we've set out to develop a new methodology this year that really unpacks the policy conversation that the UNDP and UN system and UNDP leads in many instances. It's the policy conversation for how governments prioritize their macro agenda in terms of the SDGs, and how do you unpack that and make that more investor-facing. So we've developed a new methodology that really distills the policy and the development need and helps you understand what the investment opportunity areas are that correspond specifically to those needs. And we've tested this in Brazil, and we're testing it now in 6 different geographies. And we're hoping that these investor opportunity maps, which give quite specific and granular information, as well as 18 very specific data points, it won't help actually structure your deal, but it should very much help identify where you should originate and think about doing investments that would align with the goals. So I'll stop and turn back.
Thank you. So that flows well into my question for Claus, and that is, what are some of the obstacles or barriers for institutional investors in investing towards the SDGs?
Well, I think Elizabeth described very nicely one of the main obstacles, and it is simply transparency. So transparency on projects, transparency on what is going on, because, well, the availability of data and the quality of data is really, how shall I say it, premature. This is something we really need to work on jointly, and more than happy from an investor perspective to support there, really to get transparency to another level. The other thing is, at least from our perspective as a large-scale investor, we need to have scalable investment vehicles in place. That always sounds extremely arrogant, but investing 15 million, for us, this doesn't make any sense. So we need to have 2-3 billion in 2-3 years, otherwise we would not really start to think about. And we don't have investable, scalable investment vehicles we can invest in. And this is something we also need to go through with all the different stakeholders along the chain, and really to find out how to improve that, because otherwise the large investors like us will always be shy to invest directly. We need to have vehicles. On our side, if we come, so to speak, on the demand side, yes, we balance out risk return and what we are calling real world impact. And this very much comes to the risk component here. The risk sharing mechanisms, I think there are a couple of risk sharing mechanisms out, but up to now, not really mature enough. And this also includes sustainable policy framework. For us, as long-term investors, it's extremely important that the framework stays more or less same and stable and not changing every 2 years, because otherwise it's really difficult for us to go into any asset class. And so therefore the risk-sharing mechanisms, this is one of the obstacles we also need to work on with the MDBs, with the governments, with international organizations to work on that. And lastly, and I think this is most probably, at least in my personal observation, the most relevant thing is cultural barriers. So I'm pretty new in that industry, so I'm not new in the investment industry, but I'm new in the, so to speak, SDG, ESG industry, and we are talking different languages. For us, sorry to say that very bluntly, and that includes obviously me as well. Time, for instance, is for us a scarce resource. And in some discussions, I don't observe that this is also true for the other stakeholders. And so therefore, we are pretty much committed to go a pragmatic way, to invest, to learn, to gain some experiences, but we really need to gain some experiences. So we just committed 500 million 2 years ago, and guess what? How much is invested? 14. In 2 years, this is not sufficient. And this is really, this is our commitment. We want to be part of the solution, but we really need to work along the entire chain, otherwise this will not work.
So Claude had mentioned blended finance. What about the role of blended finance?
I think it's the only way how it can work, because I think the private sector is too distant to the topics to do that without any strong partner. So therefore, I'm a big supporter of blended finance. But here again, different languages, different understanding of risk return, real world impact. This is maybe not that much of an issue, but different understanding of time. And sometimes, to be very honest, I have the impression that we observe here and there also crowding out of public money towards private money. So I'm not always sure if you need private money. And so therefore, it's really, it only works via blended finance.
Claude, do you want to come back in on that?
Well, the question of blended finance is a very large one, and obviously blended finance can be extremely useful to lower the risk or the perception of the risk on a transaction. But also there are dangers with blended finance, as my Claus has mentioned, to crowd out private sector. I think blended finance is a very powerful tool, but it has to be used carefully. It has to be used when a project is potentially can produce a positive return, potentially profitable, but just is too risky. There must be a clear exit strategy on the blended finance. And third, it has to be priced accordingly. The price has to be done by professionals. That we, how do we price a guarantee? Yeah. And that's extremely important in order not to distort the market. But yes, again, blended finance is a powerful tool that can be extremely meaningful, but it has to be deployed with care.
Yes. I also think that blended finance can help, and also public money, and I think it can also help to move frontier markets, so also to look at local currency funding, longer-term funding, longer-term fixing, and then enabling the private funds to come in. I do think that we need private funding, but I very much like your suggestion, Karen, that we shift the money. I will tell a little bit more about that as well.
Great, thank you. I wanted to come back to something else that you said, Claus, about language. And one of the things that we found at OECD is that there are these different communities out there. There's the whole development finance, blended finance community, the impact investment community, the green finance community. And some of these tools and approaches are actually similar. The objectives might be different. But what's really different are the communities around these approaches. They're almost completely different, and they're not talking to each other. So part of what we're trying to do at OECD is bring together, under the umbrella of private finance for sustainable development, these different communities to see what we can learn so we don't completely recreate the wheel. And that then runs into my next question for you, Itske, about what lessons learned can be leveraged from the green finance space. I know that you all have been very active in that area.
Thank you. Yes, on the one hand, with the 4.5 billion, we really finance the change. Yeah? So we really do the impact investing, but we're also very active in change finance. So change the financial sector and moving that more into the impact space. Recently, we also presented our vision document in the energy and climate arena, and also described what the role of the financial sector could and should be in that respect. And we are active both in Europe and in emerging markets. And recently I was at the financial task force of the Dutch climate agreement and was one of the members of that financial task force. And I would like to name you 2 lessons learned that I learned from that work. And one of them, and that has to do with the shifting towards impact investment, it has to do that do not only focus on green assets. So not only focus on the impact investments or the green assets, but also look at the exposure in the so-called brown assets. And it's really important to also disclose the portfolios of the financial sector in the brown asset field, and to make sure, in order for us all to reach the goals that we have according to the Paris Climate Agreement, to decrease and to set up science-based targets to decrease that exposure. And for that reason, we're also one of the founding partners of the Partnership for Carbon Accounting Financials. And that has been a basis in this whole process of coming to a Dutch climate agreement for the whole financial sector in the Netherlands, so being asset managers, banks, pension funds, and insurance companies, together under the guidance of the Ministry of Finance, to start reporting on our carbon footprint in the financial sector and check with each other how to decrease that. I think that is really important. One might say we follow what the economy does or what the companies are doing, and we just follow as the financial sector, but we say no, we have to lead and to really decrease that. So that's one lesson learned. The other lesson learned is to not only look at risk return, but also look at impact risk return. And impact can then be a positive value, but evenly we have to price in the negative externalities. And especially in infrastructure funds, where you have an MPV established over, let's say, 15 or 18 or 20 years of time, be careful of what discount factor to use and to see whether externalities are properly catered for. And what I found out also in that financial task force is that some of the parties said, okay, if I have the choice to invest at, let's say, 7.10% IRR in a coal-fired plant in country X, and at 7% in a renewable energy plants in country Y, with a comparable country risk. Oh, it's my fiduciary duty. I will invest in the one with a higher return. And I think we have to rethink fiduciary duty to also take into account these externalities. So I think that's my second lesson learned.
Great. Well, I saw both Claus and Claude reacting to your comments. So we'll start with Claus.
Well, I'm coming back to your first lesson learned on green versus brown or non-green investments. And I couldn't agree more. So we have about 25 billion in green assets. That's great. And we would love to see more in our portfolios. Unfortunately, there are not so many projects out, but nevertheless. But the really important thing in our philosophy to get our portfolios carbon neutral until 2050 is to finance the transition for the rest. I think this is the key thing. Just focusing on green investments, that's nice. And this also always causes headlines and everything is great. But financing the transition is the key task. And therefore, we strongly believe that intensive engagement processes with the companies, understanding their transition paths, and we are driving very much SBTi, what you mentioned, to understand transition paths for industries, but also for specific companies. This is our really basic belief how it can work towards ESG and SDG investment. So I couldn't agree more.
And I have to also agree with you. There's too much emphasis on, especially in the public markets, on picking the best companies. And if all we're doing is trying to pick the quote, best companies, what about trying to transition the ones that aren't the best? I mean, that's really where you can have the most impact.
Yeah, just want to rebound on the fiduciary duty and the return expectation. I mean, let's be very clear. There are a few exceptions, but usually you have some kind of trade-off between impact and return. There are a few exceptions, but the rule is that you have to accept sometimes a slightly lesser return, like 7% instead of 7.5. You know, those investments are in difficult countries. They are long-term in macroeconomic situations that can deteriorate. You pile up all the potential risk. Now the question is whether you want to have impact, to be SDG aligned. You need to, as an investor, to have pretty decent return. But if you're in the business of maximizing your profit completely, probably impact and SDG investing is not the way to go. One has to accept the impact up to a certain level. I understand the return has to be there, but you cannot expect a double-digit return on a consistent basis on an impact portfolio.
And it depends on the sector and the geography, et cetera. And it also gets back to what you said earlier about the real risk versus the perceived risk. And in many cases, the opportunities are better than people think, but how do you get them in? Yes.
I couldn't agree more with you that the focus also in our view should not be on profit maximization or return maximization. It should be a fair return. But I tend to disagree to say that impact investment that let's be fair, you have to accept a slightly lower return. My message was mainly about also to cater for the externalities. So if you apply true cost, true pricing, true valuing, and price in the costs of externalities, for example, CO2 emissions, then you will see a shift, and especially on the longer term. And I've been asking many parties in the financial sector also, what are your scenarios? So what CO2 price do you take into your financial calculations? So how can you say that a return in 15 years will be 7% or 7.5%? So what is behind the calculation? And I think that's where we might see a big shift in the years to come in that sense.
Well, I see some people in the room that are actually doing work in this area, so maybe we'll have a chance to get them in the Q&A. Elizabeth, what is the role of impact measurement and management in helping to increase the flows towards the SDGs? And can you talk a bit more about what you all are doing?
Right, so in that survey I mentioned when we launched this initiative, and you know, UNDP, I can give a shout out for UNDP, I'm new to UNDP, but UNDP is the global network for the UN system, and UNDP is really the custodian of the Sustainable Development Goals, working in 170 countries and working across sectors. And so somehow it is incumbent on UNDP to really drive that integrity for what it means to be SDG enabling. And currently, there is no set of standards on the market today until now that we're coming forward that would allow a third-party auditor to assure that your impact management practice, the way you report, disclose information, is of sufficient quality to be SDG enabling. And this is what we heard. We heard that we want to be aligned and we don't know how to do this. And so we set out to really work on practice standards. How do you help investors across asset classes? We've started with private equity. We've released for public consultation at the beginning of September practice standards for SDG enabling investment for private equity. And we're moving quickly to produce a set of standards for bonds and for enterprises that will follow this year. And these standards are really at the heart of good practice. And at the end of the day, transparency and comparability are what really drive markets and scale. And in the absence of having a set of standards that really help an auditor, in this case, for the veracity and the integrity of this, understand if your impact management practices are comparable, reliable, and consistent, it's very hard for any of us to understand what that means. And so we've released these standards. They are out for public consultation. They're on our website. We're super excited to have public feedback on the standards. We think that this is an important tool that is necessary to help investors, in this case fund managers, articulate what their SDG intentions are, how they're setting their SDG goals, how they're measuring, managing, reporting, and ultimately how they're disclosing and the transparency that follows. What the market really asked us for is to develop a certification process and a seal, so a UNDP seal that would actually be awarded to a fund or a firm that is compliant to these practice standards. UNDP would not be in the certification business, but UNDP will be licensing and providing some quality assurance to third-party independent certifiers that would work with a fund or work with a firm that was interested in becoming compliant to these new practice standards. And what I think is important, being part of a community that Karen's very much part of as well, is that we would like to think that this is very additive to the market. We think that the marketplace is a bit confused. There are some really important principles, and they're high-level principles that we applaud and recognize. And we think that there's tremendous new activity that's been happening in the performance metric space of our standards ratings and development organizations, where you see quite a lot of new metrics coming forward. The OECD, together with SASB, is now developing new accounting metrics for impact. We have B-Lab that's been working with the UN Global Compact to align its analytics to the SDGs. We have the Global Impact Investing Network with its impact reporting investment standards now aligning to the SDGs. So there's a whole lot of performance metrics, and I think our job has been to help this marketplace and to help investors, most importantly, by providing the how, giving good practice. So how do you take the intentions of the principles and the characteristics that are on the market, and how do you direct the users to the important metrics that have been developed so that they can report in a consistent, clear, compelling way that is also transferable and comparable, which is what we ultimately need to be able to benchmark that we are contributing to the SDGs.
Thanks, Elizabeth. And just to put that in further context, both the OECD, UNDP, IFC, and a number of organizations are part of this impact management project structured network. And we're all working together because we all are working on pieces of the impact measurement and management puzzle. And so we're working together to try to collaborate and align, because otherwise every day you hear about new metrics, new frameworks, new standards, new guidelines, and it's really confusing for the investors in the companies. So we're trying to bring some coherence and work towards some consensus around these frameworks and standards. And as Elizabeth said, it's really broken into three components. One is about practice, which is really about impact measurement. How do you think about the way you're approaching impact measurement? The other is about performance, which is how do you actually, that's the what. What are you measuring and how do you measure it? And that's what we're working on at OECD. We're working on this conceptual framework. And the other is benchmarking. How do you have the comparability to know how you're doing versus others? So very interesting work. It's ongoing, and also collaborating with many other people that are working on great work in these areas. Did you want to come in, Brie? I thought I saw your hand. Okay. Otherwise, yeah, so I do want to open up. Okay, I'm getting the sign. I wasn't sure because we started late. Do I have time to do some Q&A? Okay. So I'm going to open up to questions. I'm going to take all the questions together, and then we'll come to the panel for some closing comments. You were first, so. And please very briefly introduce yourself and briefly ask a question. Thank you.
Hi, I'm Paolo Fresia, Family Office Impact Investor. My question is for Elizabeth. And you talk about these practice standards, and measurement is very important, but as an investor who uses the SDGs day to day, I'm worried about the scaling of SDG-aligned investments if it doesn't happen in tandem with human rights, land rights protection, and building the foundations for democracy, all these terms that are not used enough in the SDG language. So that really worries me. So I'm curious, what is the UNDP doing to integrate this further as we embark in these consultations?
Okay, Randall, in the back there. He's from Texas, so he's loud. Had to get that in.
Networks of development entrepreneurs, and thank you for the Texas shout out. So this is a question, I guess, for Claus, but with the nod to Itske, which is, she's saying she has $4.5 billion of impact investments. You're saying you could only do 14 million. What's going on, and is that just the language issue that you were bringing up?
Okay, Arthur?
Arthur Wood, Total Impact Capital. I feel a bit like Banquo's ghost sitting here. And I don't really, I have to admit it grated when you say we can't do this. If there are 4 ways of crystallizing social value, one is tax and regulation. Well, both of those are in tactical retreat, and if there's a market crash, it'll be even worse. Strategically, they are misaligned, ergo the 1.3 trillion in foundations, and the fact that government balance sheets are bankrupt. So tax and regulation is not going to do it. The third is subsidy. Well, if there's $170 billion worth of subsidy inside the entire UN system, assuming nobody gets paid inside the UN system, which I could understand would be a bit irritating for many people in this room, you've got to leverage that capital 50 times. Latest ODI says it's doing 1.7 to 1.14. So subsidy isn't going to cut the route, even though if you just marriage ESG to SDG, what we will end up funding is, and what is being funded, is energy, infrastructure, financial services, and housing. And let's be honest then, that let's just take 3/4 of those SDGs off the window. Let's just be honest about it if that's what you're really proposing. The fourth solution is trade. And that's where the solution lies, and it was outlined by the Secretary General, who said price the externalities. The externalities are future cash flows lost. Why not make those tradable? And do it in a way exactly, and I say this having headed the product development unit of an Allianz entity, in exactly the same way as the banks did it. Use modern technology to change the cost structure so that we don't have continued conversations about venture capital models. Everything in finance is scale. What you do at 2 million, what you do at 5 million, what you do at 30 million, what you do at 50 million, what you do at $500 million is completely different. And we're locked in a venture capital paradigm which is constraining, and exactly the reason that you can't do it. And it's based on the cost structure we have and the fact that we don't tackle the fundamental issues with externalities. So the question I have is, are you going to price and trade the externalities?
Okay, all right. Some other very quick questions. Yes. And I want to be fair to this side of the room. Did I miss anyone over here?
Thank you very much. Just one question about the fact of accepting lower financial return, if we should or we should not accept it, especially in impact investment. Given my context, that is very difficult and socially, economically speaking, in developing countries, extremely difficult. Given that context, that's the maximum financial return I can have. Can I still call it accepting a lower financial return? If this is the maximum I can have, I'm not, that's the market. I am the market. I'm not accepting a lower return. I'm getting the maximum I can given those tough conditions. Thank you.
Okay, last chance. So we will turn to the panel. Who would like to go first? Elizabeth?
I can just answer the question that was directed more specifically. So the standards, the practice standards, and the certification, and we will provide some quality assurance over that certification and license that certification training. But in that certification, we would certainly expect and include the UN conventions would be considered. So we're not abandoning sort of traditional UN conventions as we're looking at impact measurement practice as it relates to the SDGs. So I think we're safeguarding that, if that makes you feel better.
I can take the 14 million versus 3.5 billion question. Actually, this is my key question as well. My hypothesis is that the pipelines are not materializing in a way we are used to. So yes, we are used to invest in renewable energy. We are used to invest in infrastructure, so classical infrastructure projects. But SDG investments are pretty new for us, and what we learn is that committing 500 million and doing this jointly with an MDB, well, the pipeline simply takes longer, and this is the reason why we are asking now to set up a small project to really go through the entire chain and understand better what the obstacles are, where we have, let's say, some waste of time in that we really can speed up the things. So this is my, well, obviously we could always invest in her funds, and yes, sure, but this is maybe too easy. So come to that later. No, on the question risk versus return versus impact, I don't see a contradiction. So, and honestly, as investment people, we were educated to balance out risk and return. And now we are doing like, oh, impact and return, this is a huge contradiction, but risk and return as well. So this is what we learned, this is this efficient frontier. And now we have a third dimension with real world impact. And so therefore, I don't see a contradiction, and I don't see really a change in paradigm to balance out different dimensions. And this is what our job basically is, to balance out different dimensions and to hopefully take the right decision.
I wanted to also come back on the question on land property rights and democracy, etc. I'm pleased to say that what we call energy democracy is really an important pillar also in our energy vision. And we also increasingly see cooperative structures managing energy projects or community projects, etc. And that is also kind of, it's also difficult to how to finance a wind farm that is owned by 10,000 inhabitants. How do you structure project finance with 10,000 people joining a cooperative? So it's all additional work you have to do. You have to think about it, move the markets. But I'm very pleased that at least that is one of the really important pillars, because we think that is really part of the future. And of course, land rights, all ENS factors are an important part in screening all the projects that we invest in, and we have an ENS officer really diving into that subject, and so that's really two indispensable parts, I think, for SDG financing.
Okay, Claude, you have the final word, and I'm getting the evil eye from the organizers. So
yeah, well, just on the question of market return, yes, the question is whether you want to add the third dimension, as Claus said, impact that will lower the return. And what is the alternative? You can decide that your investment universe is impact in Africa, and then you accept that return, and that's the market return. But if you have as an alternative to do private equity in the US at 15–20%, then that's when you decide to have a lower return because you're looking for impact. So it depends on the definition, if you add the third dimension of impact or not, and what are the alternatives. But it could well be that for a specific entity that wants to do only impact, that's the market return. I mean, just to say, if you look at the most experienced impact investor, the DFI, the Development Finance Institution, including the IFC, the return they have had over the last 20 years on the equity side is less than 10%. And that's not what is considered as market return in the Western world, on the equity side, on the private equity side. So that's what I say here,
So unfortunately, we need to wrap up, but thank you very much to the panel for the lively discussion. I think they're going to be around during the lunch if you want to catch them and talk further. And thank you for the great questions.